Hey everyone, welcome back to another dividend investing video. Today we're taking a look at a dividend stock that is down huge, over 45% over the last year. This is a consumer staple, a company whose products are likely in your own refrigerator today. I'm talking about Tyson Foods, ticker TSN. Investors in this company are feeling some pain, and after the worst trading week since 2008, I thought this was a good time to see what's going on with Tyson Foods. Is this a good place for some bargain shopping? Is there a value case to be made? Or are investors in for more pain going forward? While impossible to predict the future, I'll break down what I can and try to determine if this stock is a buy for long-term and value-minded dividend growth investors. I'm Nick, and this is the Dividend Growth Income Channel. Thank you for joining me today. I'm not a financial advisor or guru. I'm just a regular guy who wants to share my love of dividend growth investing and building financial independence with passive income. If you could, please do me a favor, smash the like button and subscribe to keep up with future videos. This helps us out more than you can imagine with the algorithm, so we can bring you more quality dividend investing content. Over the last month, this stock is down almost 20%. Is this a packaged food company, a defensive stock, or is this a regional bank? Tyson Foods is definitely no tattooed chef. They're the second largest processor of chicken, beef, and pork in the entire world. These are household brands you know and likely use, such as Jimmy Dean, Hillshire Farm, Ballpark, Wright Brand, and State Fair. And from the perspective of a dividend growth investor, at first glance at least, this looks like a strong dividend stock. Look, we have 31 years of uninterrupted dividends and 10 years of dividend growth. And it seems like for a while they just paid a flat dividend, but in 2013 they began raising it, and the raises were generous. Over the last 5 years, we have an average annual dividend growth rate of 15%. This is impressive. And they've been raising it at a rate of 13% over the last 10 years. So if you were using Tyson for dividend income solely, every year you were getting raises that well exceeded inflation. That's nice to have. Well, except for the last raise, right, which was announced in November of 2022, just last year, at 4.3%. This is quite a slowdown, and I'll get into why that's happened shortly. And if I was a betting man, this is going to continue given the current economic state Tyson Foods finds itself in. At the time of publishing this video, the shares are trading just under $50 a share. That's $49.47. Over that historically bad week from May 8th to May 12th, it just kept dropping and dropping and dropping each day until Thursday, when it began to slightly rebound. And I wanted to give things some time to settle before making the video. Shares dropped all the way down to $47.11, and this is coming off a 52-week high of $92.34. This is not what we expect when we're investing in a consumer staple, a packaged food company. This is one reason you see me buying a lot of SCHD these days, not being overly reliant on just like a handful of stocks. And I definitely encourage new investors to focus heavily on a foundation of ETFs like SCHD, VYM, DGROW. And if you have time to let your money compound, definitely want broad market funds like VTI, SPY, VOO. You make that foundation. Going too heavy on individual stocks, and you're setting yourself up for a lot more risk. Of course, potentially a lot more reward as well. So it's really all about your own risk tolerance. Looking at the last year, this is rough. Shares have lost nearly half their value. Over the last 5 years, shares are down 26%. And over the last 10 years, shares are up about 96%. But this is greatly underperforming the broader market. Let's take a closer look. Let's look at Seeking Alpha's Momentum tab here. I'm going to scroll down to Total Return. You see that Tyson has a total return of 134% over the last 10 years. And that's share price growth, 96%, plus dividends paid. While the S&P 500 has a total return of 205%. So Tyson has been an underperforming asset for the last decade. But the chart tells an interesting story here, because really over the last 10 years, up until about February of this year, Tyson has been outperforming the S&P by times at a large amount. This is pretty intense volatility for, again, this supposedly defensive stock. That means, look, if the fundamentals are there, and if things were returned to normal with Tyson over the next couple years, this could be a great time to pick up shares, both in terms of potential upside, as well as locking in a historically high yield for Tyson Foods. And wow, that starting yield right now at 3.88%, almost 4%. This is a stock that typically yields 2.28%. That's its 5-year average. Today, the yield is sitting 70% higher. And I like looking at this metric, but when it gets this high, when the spread is that wide, That is a sign of potential red flags, things to look out for. So what's really going on here? Well, on May 8th, Tyson announced their earnings, and frankly, it was disastrous. And the last few quarters have been rough, but they came in with non-GAAP earnings per share in the negative, and also missed on revenue. Additionally, they slashed guidance for the remainder of the year. Shares dropped about 9% on the 8th, and it continued on throughout the week. Look at this dramatic drop in earnings per share and free cash flow per share. Absolutely brutal. Now, Tyson's business has been greatly suffering due to pressure on their margins, both on increased costs of livestock and the increased expenses for animal feed. You combine that with slowing consumer demand for these increasingly expensive products, and that's the situation we have now. And that's the best way I could think to describe it. And I also think their dividend is under pressure, unfortunately. We saw dividend growth slow, but look where things stand today. The dividend is costing Tyson $1.92 per share. Now think about this. Tyson's forward earnings per share is $2.39. So this dividend is taking up 80% of forward earnings. And with negative free cash flow at the moment, Tyson can't cover this dividend with its free cash flow. This won't be sustainable. But Tyson has kept a historically low payout ratio, both in terms of earnings and free cash flow. But in just a couple short years, things quickly changed, and I can't in good faith tell you this is a safe dividend. Now long term, I do expect Tyson's going to get through this. They're in a cyclical industry. But in the short term, the stock could certainly go lower, and I would hold off on starting a position myself until I saw a bottom form. It is interesting, though. Seeking Alpha shows an average analyst price target of $61.73, and that's nearly 25% upside from where it sits today. So from a value play, it's interesting. Risky, but compelling, right? Let me know down in the comments if Tyson Foods is for you. It's not for me at this time. I'm a little more on the conservative side with my investments at this stage, but I will keep an eye on things. And as always, we'll keep you guys updated on the latest with Tyson and the other many dividend stocks of interest to value-minded dividend growth investors. Thanks for sticking around, my friends. More to come soon. Until next time, keep investing.